Hi, everyone. This is Christine Kopr, Realtor and VP of Sales with Sotheby's International Realty in Vancouver, BC, with your August market update. The July stats are out, and we're going to take a good look at how things fared over the summer. The market is in full summer mode. We are starting to see things slow down a little bit, particularly now that we're into August. But looking back in July, let's take a look at how July fared. For those of you that follow me every month, we always take a look at this graph just to put all the stats for the Greater Vancouver region into perspective. It's a quick high-level overview. This spans everywhere from Whistler to Maple Ridge, so please keep that in mind. And you can see here we're running from January to July so far for 2024. We're going to take a look at the sales, new listings, total active listings or inventory, as well as a month of inventory and our benchmark price at the end of July. So July saw 2,333 sales, down 3.5% month over month. Very typical. We're into the summer months. Things start to ease off. Traditionally, we have a much busier spring. And then once we hit June and July, things start to roll over. Things typically get quieter in August while everyone's on holidays. Then we go right into our fall market, which is the second busiest market of the year. And with the way things are looking, there's very strong chances that activity could pick up here into the fall, as we've had 2 interest rate decreases so far this year and a couple more to come, but more on that as we move on. With respect to July sales, 3.5% less than July, 5% less than our July year over year, and about 18% below the 10-year average. This is not a new story. We are seeing the similar activities we've been seeing all spring. Our sales are a bit below the 10-year average. Inventory is well above our 10-year average, and that's kind of been the name of the game for 2024, which, while that sounds pretty outlandish, it's actually very welcome and needed for the Vancouver real estate market, which has primarily been living in a seller's market since 2014. So for any buyers out there, anyone who's been wanting to transact in this real estate market, we're starting to get conditions that are more favorable to being able to transact with less pressure in many circumstances. Not all market segments, but in many circumstances. New listings in July totaled 5,597, so a bit less than June, about 2.2%, and are 20 or 21% higher year over year compared to July of 2023. For those of you that recall, spring of 2023 was an extremely busy market, but primarily the sales were much stronger, but the inventory was very low, which also really helped keep a floor on prices. And in fact, we had some price appreciation last spring, as we did earlier in this spring. And our total new listings that came on here in July were about 13% above the 10-year average. Now, total inventory, this is how many homes are available on our MLS at this point in time for the Greater Vancouver region, not including the Fraser Valley. We're at 14,326 available homes to purchase at the end of July. That's up 1% month over month and up about 40% year over year. Again, this has kind of been the tune of the 2024 market, lower than historic sales, higher than normal inventory. And that inventory seems to be accumulating a little bit by bit each month. And you can see that here below. And we're going to touch on that in just a second. 14,000 homes are about 22% above the 10-year average. What's interesting, though, for those that might be calling that the sky is falling type of message out there, interestingly, these are extremely similar numbers that we saw about this time in 2019. In fact, I took a look at the July numbers. I think we had just slightly more sales. I think it was about 2,500 sales, so just a couple hundred more sales and about the same amount of listings. This time we have a bit more months of inventory. I think it was like 5.8 months of inventory compared to 6.1 months of inventory. But what's interesting is while the market was somewhat negative, or perhaps the psychology around the marketplace was not as positive as it had been, by the fall, we actually started to see a change as interest rates started to come down, activity started to pick up, inventory started to become absorbed. And in fact, we were in crazy market conditions by the spring of 2020, and then we hit COVID, and it's been kind of a wild ride ever since. It's not unlike the summer of 2019, which was actually an excellent time to buy for a lot of people who were willing to step up to the plate and buy when things were a little bit more flat and home prices weren't growing as aggressively. Now, taking a look at months of inventory, we are sitting at 6.1 months of inventory. So for those of you that tune in every month, we go through this. 4 to 6 months of inventory is considered a balanced market. 6 months and above, so more inventory than we need for the current sales or the demand in the market, starts to become a buyer's market. So 6 months and above is considered a buyer's market, and 4 months and below is considered a seller's market. You can see here throughout the spring, while it was just on the cusp inside a balanced market, we were really seeing more of a seller's market in a lot of categories. And you can see that upward pressure on the MLS benchmark price here. And now things are starting to shift as we move towards out of a balanced market into more of a buyer's market. Now, I would argue when we break this down, we're in more balanced market conditions overall. However, every market or product type is acting a bit differently, very specifically as well. While we might have a bunch of inventory in detached, for example, it's not necessarily move-in ready or the type of product that people want to buy today. There can be inventory, and this is where some of these numbers may be a little misleading, because if you look really into, for example, move-in ready homes on the east side in the detached market, that product can move very quickly and has been very sustained, and there's just not a lot of it. So when the good stuff does come up, it gets the attention. But coming back to the months of inventory, we are sitting at 6.1 months of inventory. And the reason why we like to track this is, remember, we're looking at the overall market, which can then, when we go look at your particular product in particular, in terms of your product type, your neighborhood, location, etc., we can see how your product fits in the overall trend and what's happening in your specific product to make well-informed decisions about your buying or selling activities. The benchmark price is now sitting at 1.197 million. That's down 0.8% from the month prior, and also down 1.1% year over year. Now, that would indicate potentially to some of you that prices are all down across all categories, and that's not actually the case. Remember, again, this is the MLS benchmark price. It is a fictitious property that we benchmark against. We're going to quickly take a look at the detached townhome and apartment segment to actually see what's happening there. And you need to look even further, even when you break it between West Side and East Side Vancouver and those market segments, what's happening with pricing there. So Metro Vancouver or Greater Vancouver region, you have detached homes. Sales are up 1% year over year, so even higher than they were last year, which was a stronger market than this year. The benchmark for your detached home in Metro Van is 2.50 million. Basically, your benchmark price is up 2.1% year over year, and now just down 0.6% month over month, and sitting at a 12.8% ratio. So sales to listings or sales to actives ratio is very much like our months of inventory. It's the absorption rate. 12% and below is your buyer's market. 20% and above is the seller's market. So we're just coming out of that balanced into buyer's market. But again, it's really product dependent. Your attached townhomes sales are down 6% year over year. Your benchmark price for a townhouse is 1.124. You're up 1.3% year over year on that benchmark price, and down 1.2% month over month, with your sales to actives ratio sitting at 20%. So you're just coming out of that seller's market territory into the balanced market territory, and balance being neither favoring the buyer or the seller. Attached condo sales are down 7% year over year, with your benchmark price sitting at 768,000, so down 0.3% year over year, very much negligible, and down 0.7% month over month, almost the same. So just in some cases starting to see some of that softening in prices. I would say a lot of like the Airbnb product would probably be falling more into the buyer's market territory, 1 and 2 bedroom condos downtown, etc. Your sales to actives ratio, though, sitting at 19%, so high in the balance side of the market, almost seller's market territory. And again, it really depends on your product and location. Now, I'm going to take a deep dive into Vancouver West and Vancouver East. Make sure you tune into that so you can see how those markets are looking and how they're acting separately. But from here, we're just going to continue on with our high level market update. With respect to prices, I would say that things are holding on and actually quite well. We have a really good floor under our prices. While we've had increasing inventory, prices are remaining fairly strong. And as we've had a couple of interest rate decreases here in the summer, as we head into the fall, it's quite possible that we're going to see a bit of an uptick into sales as things become more affordable. That's all all contingent on this inventory and, of course, the economy. And we will get into some of those factors throughout this market update as well. Touching on interest rates. So we've had those 2 quarter-point interest rate decreases this summer. So that's been fantastic. However, there hasn't been a huge spur in activity yet. Those decreases impact your line of credit or your variable rate mortgage. So anybody with a variable or line of credit is feeling a little bit better because their payments are either coming off or they're putting more money towards principal. So that's great for those types of product holders. And anybody getting into the market today is probably deliberating whether they write a variable down or they take a 3-year fixed rate mortgage. And the 5-year Canada bond influences the mortgage bond rates, which influence and determine the fixed mortgage interest rates. And you can see here, even back in May of 2024, the 5-year government bond was sitting at 3.3, and now it's sitting at 2.9. So things are moving in that fixed rate market, which does impact home buyers' buying decisions, as well as refinancings that a lot of people have been talking about with the supposed mortgage renewal wall. One thing to consider, while we still have a lot more mortgages rolling over in 2024 and 2025 and 2026, it is worth noting that that stress test that was initiated back in 2018, 2019, it forced borrowers to be stress tested at much higher rates. A lot of the people that are coming into the renewals would have been stress tested in that 5% range. And the good news is today there are a lot of rates that are hovering around that 5%. So while nobody wants to afford their mortgages at the 5%-ish rates, it is positive with respect to the affordability factor, people being able to hang on to their properties and perhaps preventing some of that speculation that perhaps there might be people that need to sell just because they can't afford their mortgages anymore. I'm not saying that doesn't exist. There is a segment of the population that will be impacted. However, I would say that it is very positive to know everybody was stress tested at a much higher rate, anticipating that interest rates would have changed in the future. And this is probably why we're not actually seeing as many mortgage holders roll over into more of a delinquent state. Now, other recent news is the eviction notice timeline that was recently announced by our government. It was changed again. So because the government decided not to do any consultation with any of its industry peers, specifically in real estate or in finance, there was a lot of pushback because while they were protecting tenants, most governments right now, their narrative is to make housing more attainable and affordable for their voting populace. And of course, by enacting the 4-month notice that actually prevented buyers from being able to get into the marketplace, the very people that they're trying to earn their votes from. So they had to backpedal, and they're now changing the rules, but it's specific to if you are a purchaser, then only 3 months notice is needed to be provided to the tenants. They had moved it to 4, but they're backtracking to 3 months so that purchasers have the ability to secure their financing, because the 4-month was preventing them from being able to do that. So purchasers get to give 3 months notice. However, if you're a landlord, you still need to provide 4 months notice if you're trying to take occupancy of your own property. If you're a landlord and you're be selling to a buyer who's going to owner occupy, then only 3-month notice is required. And if you're a landlord just trying to move back into your own property, you have to provide 4 months notice. Not super friendly landlord rules, but it is what it is in the province of British Columbia. Speaking of changes, these are some of the summaries of changes that our recent government has made, and one of them being the Airbnb ban. And in recent news, we've been noticing articles popping up, like, for example, in tourist towns like Kelowna, not seeing the economic activity or the tourists coming into town, many blaming the Airbnb ban, which is hampering people coming into the region because there's not as much affordable accommodation. In the midst of our Okanagan region, suffering 2 years of extreme weather, decimating many vineyards and potentially wineries, as well as our soft fruit industry. We also have had multiple years of forest fires, which impacted tourism in this region. And then, of course, our government decided to enact the Airbnb ban, which, of course, hampers the economic activities in these areas. So something to consider when our time to vote arrives upon us, to keep some of these things in mind. And while it might seem like the Airbnb ban makes a lot of sense and is going to have some great impact, it's worth noting that it is actually quite negligible in the grand scheme of things. This is a source from Stats Canada. Apparently, this is a table that shows the amount of potential long-term dwellings as a share of housing units. Potential long-term dwellings, I am guessing, I have not verified, is an indication of how many homes are in the marketplace which could come into a long-term dwelling unit, aka currently being operated as an Airbnb. The entire amount of homes apparently are 107,000 across Canada. This is not even half of what we need for 1 year of new home construction. So the fact is that even if we took all Airbnbs off the marketplace, it would be a very, very short-term solution with respect to the amount of homes we actually need to deliver into our marketplace. And I would actually suggest that people start not balking at the thought of having real estate be an investment, but actually start realizing that it is. Because without somebody investing in real estate and getting a return on their capital, no one will be buying or investing in real estate. Even if you want the government to do it, just as a reminder, the government is actually spending your money. So we need to take a look at these policies and think about how they're going to impact the market. Therein lies the rub. The fact is I think that there's still going to be an upward trend eventually in our real estate market as interest rates become more affordable and people are feeling confident with their employment. The one thing we do have to look out for is a weakening economy. Inflation is coming down, which is a very positive thing. But these high rates do have the possibility of impacting our economic stability. And if it does impact the economy too negatively, then we will have lowered interest rates, but for the very reasons that we don't want to have them, which is job loss. The jobs in BC have actually remained strong. Unemployment is still hovering where it was, but in all of Canada, we're starting to see an uptick in unemployment. So it is something that we have to keep an eye out on. But so far, government policy hasn't really done anything to help increase the housing supply in a very meaningful way in terms of getting homes to the market faster by making it economically viable and sound so that builders and investors enter the marketplace. That's your market update for August. It's a little bit quieter than usual. However, deals are getting done. It is definitely a time where you have to be very strategic when you're pricing your home as a seller. You want to do your due diligence when you're a buyer. And it doesn't always mean that you can take all your time, but in many circumstances, you do have the supply and the inventory and the time to do your due diligence, but you still have to be ready to be able to act fast because good product sells. I'm Christine Kopr with Sotheby's Realty in Vancouver, BC. That is your August market update. Make sure to like and subscribe on my Instagram and my YouTube. And if you're not already a newsletter subscriber, which is where this usually is sent to you every month, make sure you subscribe to my newsletter for information like this and others. I look forward to connecting with you and always welcome the opportunity to connect.